Have you ever heard of a 2-1 buydown? We're going to talk about how you can save hundreds of dollars in the first few years of your mortgage through this program right after this. Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, real estate, and interest rates, and we're going to start with those interest rates. Just as I had mentioned before, which I will link right up above, I said those rates are going to be coming right back up. We actually went down below 5% and back up almost a quarter over the last week. You can follow the link below to Freddie Mac's weekly survey on the average 30-year fix. You can kind of see the historic value of where we've been from year to year, week to week. Absolutely great tool to understand where we've been and the current trend that we're going. While you're down there, hit that like button, hit that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. So as mentioned, rates back up. This just proves that volatility is 100% still in this market and will likely continue through the rest of this year. Now let's get to the meat and potatoes of what we want to talk about today, and that is what we would call a 2-1 buy down. There's other options out there, 3-2-1, but a 2-1 buy down as a whole. Essentially what it's doing is it's buying down the rate 2% over whatever that 30-year fixed rate is in the first year, and then 1% in the second year. So let's assume a 5% interest rate. That means the first year you're getting a 3% rate, the second year you're getting a 4% rate, and then year 3 and beyond, you're going to be at that standard, that 5% over the long term. Now, let's talk about pros and cons. Why is this a good thing? Why isn't everyone doing this, right? Well, there's a cost associated. Now, a lot of builders and new construction will offer this. They probably didn't do it in 20 and 21, but they definitely did it in years past to incentivize buyers to their projects. Now, sellers can actually pay for this as well. So that's one of the key parts, is that sellers can actually offer an incentive to the buyer. And I've done a video before, which I'll link above, to other options of buying down a rate from a seller perspective. But this is an option to slowly get into that payment, right? And that's one of the pros, is you can ease into that higher payment as you're going up in value in terms of your purchase. Now, there's never anything in life for free, right? So why would the seller not want to, potentially pay for that? Maybe you don't get an offer. Well, there's a cost associated. If you're saving, say, $200 per month, that's $2,400 in the first year. Let's say you're saving $100 per month in the second year. That's another $1,200. That's $3,600. You're essentially just prepaying that interest up front. So if you can get the seller to pay for it or have some other incentive from the sell side, then that is a great option to look at. Now, we want to get into those cons. And as I mentioned, there's never anything in life for free. But really what I want you to think about is that cost that's associated with doing a 2-1 buy down. Can you put that money towards something else in the mortgage, like, say, buying down the rate permanently, that could actually benefit you over a longer period of time? And that is why you really need to be looking at programs and speaking with a seasoned mortgage professional to be able to outline various options for you of what would this look like. Maybe we could buy down that rate to 4% over the entire 30 years. So instead of going 3 to 4 to 5, and then the next 27 years or 28 years, you're at that 5%. Maybe you could have it permanently down at 4 for the same cost. So, as I mentioned, the market is volatile, so it's changing. It's ever changing. So understanding what you can do is extremely important. But to summarize, the 2-1 buy down is essentially buying down the rate, say 2% in this case in the first year, 1% in the second year, and then having a constant fixed rate mortgage through the rest. There's also 3-2-1 buy downs, 3% in the first year, 2% in the second, 1% in the third. So there's different kind of structures and options. And a lot of times the marketing material and out there is like, oh my gosh, look how low my rate is in the first year, and look how it can, save you all this money. But you need to understand, there's never anything in life for free. Somebody's prepaying that cost. Where is it coming from? What's the consequence there? And you absolutely positively want to feel comfortable with that year 3 payment and on that rate that you're actually getting at the end of the rainbow there. Because if you don't feel comfortable with that, if that feels like you are stretching to get there, then it's likely not a program for you, because you probably need to bring that purchase price down, put a little more down payment, just get that monthly payment down so you can feel comfortable even after year 3 and beyond that you're in the right kind of budgetary payment for you. So this is the Mortgage Minute. My name is Ryan Skaggs. Thank you so much for tuning in. If you haven't clicked that subscribe yet, please, 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 I would be forever grateful for the subscribe. Stay safe, and we'll see each other again very, very soon.